Findings in the fourth annual U.S. Bank Small Business Survey brings hope to Ohio. The survey shows that 20% of Ohio's small businesses are likely to add new jobs in the next year. Nationally, just 16% plan to increase employment. Top concerns for Ohio small business owners are the federal budget, the debt situation, health care, and taxes. And we'll have an in-depth interview on that survey coming up in just a couple of weeks here on the Business Watch. Despite that good job news this week, we continue to be somewhat trapped in a slow-growth, low-interest rate economy. If you believe the Federal Reserve, interest rates will remain very low until 2015. While low interest rates seem to be good for borrowers, they're not so good for savers, retirees, and investors. It's really hard to generate income with interest rates this low. In this morning's U.S. Bank Economic 360, U.S. Bank senior equity strategist Jim Russell joins us with perspective on this issue. Jim, good to have you with us.
Brian, good morning.
You work with investors. How important is income to the most investors that you're connected with?
Well, our investors are really concerned with a number of things. Budget deficit is one of the things that you just mentioned a minute ago. Unemployment rate, but right at the top of the list is sustainability and generation of income in the low interest rate environment that we have. These are the lowest interest rates we've had in a generation. And as you mentioned, Brian, a 5% bond or a 6% bond that was bought 7, 8, 9 years ago is now coming due, and the reinvestment rate is a generation of 1 to 1.5% of income. So we find the investors are actually having to take a pay cut, which is really problematic for many retirees.
Nobody really wants to take a pay cut. So how do dividends compare with interest rates? Are they more attractive?
In many cases they are. And what we're going to see here in just a second is that compared to interest rates, dividends are actually higher than the 10-year Treasury note. Right now, the S&P 500 yields about 2.1%, and the 10-year Treasury note yields about 1.7%. Now, this is a very unusual type of relationship that we don't normally see. And so what we're seeing also is that many stocks in the S&P 500, about 50% of the stocks in the S&P 500, so approximately 250, generate a dividend yield of over 1.7% or over the current 10-year Treasury note. Again, a very unusual type of relationship, and we think that stocks can be substituted for bonds to generate income. Now, this is something we're likely to see more of as we move forward. This isn't temporary. Currently, 406 stocks in the S&P 500 actually pay a dividend, the highest since 1999.
So there are inflation concerns. Do you have any ideas for inflation beating direction that you could give us?
Yeah, investors, retirees, etc., depend upon investments primarily to beat inflation and generate income and maintain spending power. So what we're seeing is that there are really, the way things are is that many companies have a lot of cash on the balance sheet. Normally, a company pays out about half or 50% of its net income to shareholders in the form of dividends. Currently, they're paying out about a third of all net income in terms of dividends to shareholders. So we do feel that these averages can return to the historical norm, thus indicating that dividend growth in going forward is likely to be pretty high. 5, 6, 7, 8% per year increases in the dividend are very likely. In fact, 157 companies in S&P 500 year to date in 2013 have increased the dividend, and we think more to come.
All right, thanks for your expertise. We appreciate you at U.S. Bank, Jim.
Thank you, sir.